Welcome back to the deep dive. We try to cut through the noise, get you those core insights.
That's the goal.
And today, we're diving into something that can feel a bit dense sometimes, making smart financial decisions, especially, those big long-term investments. We're talking about investment appraisal.
Right. The really key area.
Super critical for businesses, sure, but also for, anyone making significant financial moves.
Absolutely. Individuals, too.
But here's the thing. It seems straightforward, right? But the actual calculations, they can get surprisingly complex, potential pitfalls everywhere.
And that's exactly what we're focusing on in this deep dive. We're really zeroing in on the advanced stuff with net present value NPV and internal rate of return IR.
The big two.
Yeah, the most important methods. Our mission today is basically to pull out the crucial insights from the material we've looked at. We want to give you a clear path through those common problem areas, things that often trip people up in the real world, trying to take something that feels overwhelming and, simplify it, make it clear.
That's the plan. So by the end of this, you should feel much more equipped, more confident about tackling these challenges, turning dense theory into something practical,
Right.
Accessible.
Hopefully, yes.
Okay, let's unpack this then. So let's maybe start with the basics. The source material lays out those foundational methods. Payback, accounting rate of return.
The simpler ones. Yeah.
And then the discounted cash flow methods, net present value, NPV, and internal rate of return, IRR. And right off the bat, it flags NTV as the most important one. Both, it says, in the real world and in the exam.
Yeah, and what's fascinating is why NPV gets that top spot.
Okay.
Is because it properly deals with the time value of money. The basic idea that $1 today is worth more than $1 in 5 years.
A simple concept, sure.
Simple concept, but it adds layers of complexity to the calculations. And that's where we hit these problem areas, the research highlights. These are the things you absolutely have to get right for an accurate appraisal.
Makes total sense. So let's tackle the first big one, inflation. Always a factor.
Always.
It seems straightforward, but the source actually mentions two ways to handle it. The money method and the real method. Why is getting this right so critical? What's the difference?
It really is critical. Inflation just eats away at value, doesn't it?
Yeah.
So the money method and the real method are about dealing with that erosion.
Now so.
Well, the money method, sometimes called the nominal method, means you inflate your future cash flows to what they'll actually be in those future dollars. And then, crucially, you use a discount rate that also includes inflation.
Okay. Matching like with like.
Exactly. The real method strips inflation out of both the cash flows and the discount rate. You work purely in today's values.
So when do you use which?
Practically speaking, the guidance is pretty clear. You have to use the money method as soon as you've got cash flows inflating at different rates. Or, importantly, if you have both tax and inflation in the picture.
Which is common.
Very common. So the money method is usually the way to go. And to get that correct discount rate, the money rate, you need the Fisher formula.
Ah, yes, the formula.
It's 1 plus I, 1 plus R, times 1 plus H. I is the money rate you need.
Yeah.
R is your real required return, what you want after inflation. And H is the general inflation rate.
Got it. So I is the rate that accounts for both the real return and the inflation.
Precisely. It ensures your discount rate matches your inflated cash flows. Oh, and one more distinction. There's the general inflation rate, H, affecting the discount rate and maybe some costs, and then potentially specific inflation rates for particular things like maybe sales revenue inflating faster than costs.
Lots to track there. Okay, moving on. Let's pivot to taxation. I liked how the source put this. The good, the bad, and the ugly.
Yes, it's a good way to think about it. Capture the different angles.
So break it down for us. What's the good, the bad, and the ugly of tax in appraisals?
Okay, so the good news is often tax relief. Governments often give tax breaks on the money you spend on assets through things like tax allowable depreciation. This creates actual tax-saving cash flows. Money back, essentially.
Nice. The bad.
The bad news is pretty obvious, I suppose. If your project makes money generates net revenue inflows, the tax authorities will want their share. So tax payments become a cash outflow.
Makes sense. And the ugly?
The ugly issue is all about timing. This causes a lot of confusion. Tax isn't usually paid the instant you make the profit. Often it's paid, say, 1 year in arrears.
The delay.
Exactly. So the tax related to profit you earn in year 1 might not actually be paid out until sometime in year 2. Getting that timing wrong in your cash flow table can really mess up the NBV.
I can see that.
Yeah.
Right, next challenge, working capital, WC. This one feels counterintuitive sometimes.
It really does. Even for people in business, the key thing, the absolute core insight is this. An increase in working capital is a cash outflow.
Outflow. Explain that.
Think about starting a project. You probably need to buy more inventory, right? Or maybe you need to give customers more credit initially. That ties up cash now. Even if you get it back later, it's cash leaving the business at the start. It's an investment.
Okay, like upfront investment in operations.
Exactly. Conversely, if working capital decreases, maybe you manage inventory better. That's a cash inflow. And crucially, at the end of the project, whatever working capital you tied up is usually released. You sell off the final inventory, customers pay up. That's a final cash inflow.
So it reverses out at the end?
Mostly, yes. The really vital point is that it's the change in the level of working capital each year that is the actual cash flow you put in your table, not the total balance. And a quick check. The sum of all those working capital cash flows over the whole project. It should ideally net out to zero.
Good check. Okay, now, relevant versus irrelevant cash flows. There's a golden rule here.
Yes, a simple but powerful rule. To be included in your investment appraisal cash flow table, an item must be a future incremental cash flow.
Future incremental. Break that down.
Future means it hasn't happened yet. Incremental means it only happens because you do this project. It wouldn't happen otherwise.
So what's irrelevant then? What gets excluded?
The source gives clear examples. First, sunk costs, money already spent. Maybe you paid for market research last year for this project idea. That's gone. Irrelevant now.
Can't get it back.
Exactly. Also, apportioned or allocated fixed costs, like a share of the head office rent. That cost exists whether you do this project or not, so it's not incremental. Don't include it.
Right. Avoid costs that aren't directly caused by the project.
Precisely. And finally, all financing costs, things like interest payments or dividends. They are irrelevant for the NPV calculation itself.
Why is that? Seems important.
Because the cost of financing the return required by the investors providing the capital is already captured in the discount rate you're using, including interest payments as an outflow, and discounting would be double counting the cost of money.
Got it. Avoid the double count.
Correct.
Okay, last problem area. The fixed appraisal horizon. This sounds a bit subtle.
It is, but it's important. Often companies won't try to forecast cash flows for, say, 20 years. They might set a shorter fixed appraisal horizon, like maybe 4 or 5 years, just to make the analysis manageable.
Sensible.
Yes, but here's the nuance. Even if you appraise over, say, 4 years, but the project has knock-on effects after that, particularly tax effects.
Like the tax paid in arrears.
Exactly. If the tax on year 4 profits is paid in year 5, even though your main appraisal stops at year 4, you must include that year 5 tax cash flow. You can't just ignore consequences that fall outside the chosen window. It needs to be complete regarding things like tax lags or working capital release.
Okay, so the horizon sets the main period, but you still capture trailing effects like tax.
You got it. A complete picture is essential.
Right. We've broken down these tricky areas: inflation, tax, working capital, relevant costs, the appraisal horizon. Each one is a potential pitfall. But the real test is when they all come together, right, in one complex scenario. And that's where the CBS Capetic example from our source material comes in. It's described as very comprehensive.
It really is. It's designed specifically to build in as many of these tricky issues as possible. It's like a masterclass in applying all these concepts at once.
So before we get into the numbers, what's the key advice from the source about tackling something like CBS Co?
Oh, this is crucial advice. It says, many students fall into the trap of starting the cash flow table too quickly. Resist the urge.
Do the prep work first.
Exactly. Do your workings or thinkings first. Calculate the inflated figures, the tax implications, the working capital changes separately. Then build the final table. You'd save so many errors.
Makes sense. Structure the thinking.
And just quickly, another point it clarifies, especially for learners, the difference between T and year. T is now a point in time. T1 is the end of year 1, also a point in time. Year 1 itself is the period between T0 and T1. Getting that timing clear is fundamental. Good clarification. T is a point, year is a period. Okay, so let's walk through some of those key workings for CBS Cone, focusing on how they tackle these challenges. Working 1, inflation and money cost of capital. We already touched on this, but in this specific example, why was the money method mandatory again?
2 reasons collided. The project involved both taxation and different cash flows were inflating at different rates. That combination forces you into the money method.
Right. So applying Fisher.
Yep. The source gives a real cost of capital R of 7.7% and general inflation at 4%. So 1 plus I plus 0.077 times 1 plus 0.04.
Which multiplies out to
about 1.12. So 1 plus I equals 1.1, meaning the money cost of capital I is 12%. That's the rate you need to discount all those future inflated cash flows.
Okay, 12% it is. Now, working 2. Tax benefits on tax allowable depreciation. Tay-day. What's the key timing trap this working illustrates?
It really highlights that tax lag. So the asset is bought at T0. You calculate the first chunk of TAD for year 1, which happens conceptually at T1.
But the actual cash benefit the tax saved, because of that appreciation allowance, only hits your bank account at T2, because tax is paid 1 year in arrears in this example.
So the cash flow is delayed a full year after the period it relates to.
Precisely. Miss that delay and your NPV is wrong. Oh, and the source also makes a practical point here about rounding. In complex examples like this, maybe work in thousands, use 1 decimal place. It simplifies things, reduces the chance of silly math errors.
Good practical tip. Okay, working 3, working capital, that counterintuitive one. How does CBS Co. handle it?
First, it establishes the need. It says working capital needed is 10% of sales revenue for that year. But remember, sales revenue itself is inflating each year.
So first you have to inflate the sales figures correctly, year by year, cumulatively.
Yes, exactly. Then you calculate 10% of that inflated revenue for each year to find the target working capital level.
And the cash flow is?
The change in that target level from 1 year to the next. So the need for year 1's working capital, that cash outflow happens at T0, right at the start. The additional amount needed for year 2, that outflow happens at T1.
The increment each year.
The increment. And don't forget the end. At T4, the end of the appraisal, the entire cumulative working capital investment is assumed to be released back. That's a big cash inflow at the very end.
Got it. The change year on year, then the full recovery at the end.
That's the pattern. Once you've done those careful workings, then you build the main cash flow table.
And how does the source suggest structuring that table?
It recommends splitting it.
Yeah.
Have a revenue section at the top, things like sales, costs, the resulting tax, things that are generally taxable.
Okay.
And then a capital section below, things like buying the initial asset or those working capital cash flows we just discussed. These aren't usually directly taxed in the same way as profits.
So separating taxable operating flows from capital flows.
Exactly. It helps keep things clear, especially for applying the tax calculations correctly. And it reinforces those timing assumptions.
Yeah.
Year 1 sales revenue. Assume it arrives at T1.
Yeah.
Variable costs related to year 1, T1. Fixed costs, well, they're fixed. They don't change with output, but you do still need to inflate them if you're using the money method.
Right. Inflate the fixed costs too.
Yes. And then all those net cash flows year by year from T0 out to T4, and maybe capturing that trailing tax in T5, you discount them all back to today using that 12% money cost of capital we calculated in working 1.
And after all that careful work, the result for CBS Co.
The final calculation shows a positive net present value of $88,300.
Positive NTV, so the decision.
Based on the decision rule from the source material. A positive NPV means the project is expected to generate more value than it costs, considering the time value of money and risk. So it should be accepted as it will add to shareholder wealth.
Your decision rule.
Yes. And while, look, that CBS CAC example was deliberately complex, packing a lot in.
For sure.
It does a brilliant job of showing how all these elements, inflation, tax timing, working capital shifts, relevant costs interact. These aren't just theoretical issues. They pop up again and again in real financial analysis and, yes, in exams too.
Absolutely. So wrapping up, we've really gone beyond just defining terms today. We've unpacked the core methods, but more importantly, dug into those critical problem areas in investment appraisal. Hopefully, we've turned some potentially confusing calculations into more understandable, actionable insights for you, giving you a clearer map, really, for navigating these complex future investment choices.
And maybe a final thought for you to take away and consider. Given how hard it actually is to perfectly forecast things like inflation rates or predict future changes in tax laws.
Which is very hard.
Exactly.
Yeah.
How might your view of an investment's true value change if the actual inflation or the actual tax rules turned out significantly different from what you initially projected in your appraisal?
That's a big question. What assumptions are we making?
Right. It leads to that deeper question. What other hidden assumptions might be lurking in any financial model? And maybe more importantly, how can we build more robust strategies, perhaps sensitivity analysis or scenario planning, to account for that inherent uncertainty?
Definitely food for thought. Building robustness into the analysis. Great questions to ponder. Keep those insights sharp, everyone, and we'll catch you on the next deep dive.